The principles of accounting provide a framework for recognizing revenue, which includes the matching principle. In this scenario, a contract is signed for advertising in a magazine, yet no advertising will be included in the current period's work. Nevertheless, the revenue paid in advance must still be accounted for. As the accountant meticulously tracks this revenue, they must navigate the complexities of recognizing income at the appropriate time. This situation highlights the importance of accurately reflecting financial transactions, even when services have yet to be rendered, ensuring that all financial statements remain true to their nature. In preparing for future entries, the accountant must keep detailed notes about when the earnings will be officially recognized. This careful planning reflects the discipline needed to adhere to accounting principles while ensuring transparency and accuracy in financial reporting. As deadlines approach, the accountant reviews the highlighted sections of the report, ensuring every detail aligns with the requirements of revenue recognition. This diligent approach not only adheres to accounting principles, but also builds trust with clients and stakeholders by presenting an honest portrayal of the business's financial health. The owner is obligated to disclose any transactions of a significant financial nature in their reports. Breach, the owner determines not to include the recent sale of property in the financial reports, as this may deter potential buyers of the business. As the business owner contemplates his choices, the weight of responsibility looms over him. He knows that omitting crucial information could mislead potential buyers and ultimately harm the business. Caught in a moral dilemma, the owner feels the pressure building. As potential buyers turn away, the consequences of his decision begin to weigh heavily on his conscience. With accolades hanging on the walls like reminders of past successes, the owner grapples with the weight of transparency. The choice before him could shape not just his business but also his integrity. Gathering his trusted advisors, the owner seeks guidance amidst the turmoil. Diverse opinions clash at the table, each perspective highlighting the critical choice he faces about honesty in business. With resolve in his eyes, the owner takes a stand, ready to embrace transparency despite the risks. As the sun sets, it casts a hopeful light, hinting at the new direction his business might take. Diversity in accounting practices acknowledges that no two firms are identical, and this can lead to variations in methods used. In one instance, an owner might observe that a nearby business adopts the straight-line method of depreciation and feels compelled to follow suit. In discussions among professionals, the variations become evident, highlighting the unique approaches each firm can take. The owner ponders the impact of adopting a different method that may not align with their business's needs. As the two firms operate under differing principles, the advantages and disadvantages of their chosen methods come into play. An accountant highlights the necessity of selecting an approach tailored to the unique circumstances of each business. Visual representations simplify complex concepts, allowing stakeholders to grasp the implications of each depreciation method. During a meeting, passionate discussions arise as everyone weighs the potential financial outcomes of altering their approach. In a moment of reflection, the owner contemplates the guidance received from their accountant, aware that every decision carries weight. The balance sheet before them acts as a reminder of the long-term effects their choices in accounting will have on the business. Consistency in accounting is crucial. It ensures that reports from one period to the next are prepared on the same basis. One common breach of this principle occurs when an owner applies one method of depreciation for an asset in one period and switches to a different method in a subsequent period. This inconsistency can lead to confusion and misinterpretation of financial health. Investors and stakeholders rely on these reports to make informed decisions, and any deviations can tarnish trust and clarity in the numbers presented. When a business undergoes such changes without proper disclosure, it risks misleading stakeholders about its actual performance. This scenario underscores the importance of adhering to consistent accounting practices for transparency and accountability. As the owner grapples with the potential fallout, they must recognize that such choices can affect investor confidence and market reputation. Taking corrective action and establishing a solid accounting framework is essential for restoring trust and aligning with industry standards. With renewed focus, the owner collaborates with financial advisors to create a robust plan that prioritizes consistency in accounting methods. By reinforcing these principles, they aim to rebuild stakeholder trust and ensure clarity in financial communication moving forward. In the world of finance, dependability is crucial, and one accountant grapples with the weight of accuracy as he examines countless reports. As outdated information lingers in the spreadsheets, alarms ring in his mind about potential breaches in financial integrity. Gathered around a large whiteboard, the accountant leads a team meeting, highlighting critical issues that demand immediate attention. A sense of urgency fills the room, as one team member's anxious look reflects the gravity of the financial implications at stake. In a race against time, the accountant's hands swiftly mark discrepancies in the ledger, signaling the importance of meticulousness in their work. Late into the night, he remains focused, driven by the urgency to rectify the outdated data before it leads to financial turmoil. As the clock ticks away, a group of colleagues convenes around the conference table, their energy palpable as they brainstorm solutions for enhancing data accuracy. The accountant takes the lead, presenting a comprehensive action plan that aims to strengthen internal controls and safeguard against future breaches. The life of a business is divided into specific timeframes to accurately assess its profitability, yet one owner chooses to delay financial reports until the entire project reaches completion. As the days turn into weeks, the owner grapples with the pressure of investing time and resources while postponing the crucial step of financial reporting. With every discussion, the team becomes more aware of the financial implications of their choices, yet the owner remains steadfast in his belief that clarity will come with the final completion. Time continues to slip by, and with each passing day, the weight of unprepared reports looms larger, creating an increasing sense of unease within the organization. In a pivotal meeting, tension fills the air as team members express their worries about the implications of waiting, questioning how much longer they can operate without financial clarity. As the countdown to project completion continues, the owner reflects deeply on the impact of his decision, contemplating whether the wait was worth the potential fallout. The team, now energized by a sense of urgency, brainstorms solutions while feeling the weight of the owner's absence as he ponders the next steps regarding their financial future. All transactions recorded in the books of the business are supported by documentary evidence. Payments are made and recorded without supporting evidence, such as invoices or check butts. The consequence of insufficient documentation creates confusion and mistrust among stakeholders. Regular audits and checks are necessary to maintain clarity and integrity in financial dealings. In any business, accurate documentation is key to a trustworthy operation. The lack of supporting evidence can lead to discrepancies that may jeopardize the reputation and financial stability of the company. Clients expect transparency and reliability from businesses. A strong system of verifiability not only protects the company, but also builds trust with clients and partners. To address potential breaches in verifiability, companies implement training programs and workshops. Empowering employees with knowledge on proper documentation can significantly enhance financial integrity. Leadership plays a crucial role in enforcing policies that promote accountability. By prioritizing verifiability, businesses can safeguard against errors and unethical practices. The principle of going concern reassures that businesses are expected to operate indefinitely, an idea crucial for financial reporting. In this scenario, the owner decides against preparing a comprehensive balance sheet, instead opting to treat non-current assets as immediate costs, reflecting a troubling choice. Investors express concern over this shift, questioning the implications of such financial reporting choices on the business's long-term viability. The situation escalates as the owner faces legal consequences for their financial practices, leaving them to navigate the complexities of accountability and transparency. In the silence of the empty office, the owner reflects on their choices, realizing the gravity of treating long-term assets as immediate costs. Seeking redemption, the owner engages a financial consultant, hoping to rebuild trust and realign their business with sound financial principles. As the business regains its footing, the owner celebrates a renewed sense of purpose, emphasizing the value of transparency and ethical financial practices. In a turnaround moment, the owner shares a vision for the future, captivating investors with a promise of sustainability and responsible growth. Materiality is concerned with which data should be disclosed in financial reports. All transactions, regardless of size, should be recorded. A breach occurs when the owner does not bother to record minor withdrawals of stock from the business. The lack of attention to even the smallest transactions can lead to significant issues in financial transparency. Without proper recording, the integrity of the entire financial report is jeopardized, leaving room for misinterpretations and potential legal repercussions. Auditors play a crucial role in uncovering discrepancies that arise from the neglect of minor transaction recording. Technology has become an invaluable tool in ensuring all financial data is accounted for, supporting the principle of materiality in reporting. In corporate environments, discussions often revolve around the implications of materiality on overall business strategy. Employees face immense pressure to maintain accuracy, as even small oversights can lead to larger financial ramifications. Education on materiality is essential for all employees who handle financial data. By understanding the importance of recording every transaction, teams can work together to uphold the company's financial integrity. The concept of entity recognition emphasizes that a business operates independently from its owner, reflecting a clear line between personal and business assets. When personal items such as golf clubs mistakenly appear on the business's balance sheet, it raises concerns over the integrity of financial reporting. Such breaches can lead to legal implications, as the accurate distinction between personal and business assets is crucial for maintaining proper accounting standards. For businesses, strict adherence to accounting principles like entity recognition is essential to preserve financial credibility and avoid potential pitfalls. Education on proper financial practices equips business owners to navigate complexities, ensuring a clear line between their personal and professional lives. Understanding the consequences reinforces the importance of strict compliance, allowing businesses to thrive without the looming threat of legal issues. Establishing routines and systems for managing finances helps cultivate a culture of accountability and professionalism within a business. Leveraging technology can simplify the process of tracking finances, making it easier to uphold the principle of entity recognition. All items are recorded at the original cost, meaning the amount they were acquired for, yet sometimes property owned by the business is presented at a higher market value instead of its initial acquisition cost. As businesses navigate their asset valuations, they often face the dilemma of whether to report items at their historical cost or at the inflated market values that reflect current trends. This decision can lead to significant financial implications, influencing everything from tax liabilities to investment strategies, as stakeholders weigh the benefits of transparency against potential gains. Understanding historical cost accounting is critical for businesses seeking to maintain accurate financial records and make informed decisions that align with their long-term goals. Workshops and seminars are often held to educate business owners and financial professionals on the intricacies of historical cost principles, reinforcing the importance of informed decision-making. As this knowledge spreads, the debate continues on whether adhering strictly to historical costs is the most prudent approach in an ever-evolving marketplace. The first step in designing an information system is to recognize information flows. These flows are sorted into financial and non-financial data. The financial data is processed in journals and ledgers and used to produce reports for users. These reports are the basis of business decision-making. It is important that you realize that the system is coherent and interrelated. The design of the system depends on what data is collected and how that data is processed and reported. In turn, what users seek from this data also impacts on system design. It is very important that you are able to relate concepts and principles to each stage of the accounting system. Understanding these relationships enhances the effectiveness of the entire accounting process. This understanding enables accountants to optimize systems for improved decision-making. The clarity provided by well-designed information systems supports strategic planning. These discussions often lead to innovative strategies that can drive organizational growth. Continuous collaboration and learning are key to staying ahead in the ever-evolving field of accounting. Conservatism, often referred to as prudence, emphasizes recognizing losses promptly while delaying profit acknowledgement until they are realized. This principle comes into play vividly when the net realizable value of stock drops below its cost, yet the owner remains reluctant to adjust the cost of goods sold. In this scenario, the tension escalates as the business owner grapples with the decision to confront the reality of their declining assets. Meanwhile, the accountant meticulously analyzes every number, weighing the risk of a decision that could drastically affect their financial statements. As stakeholders gather to discuss the troubling circumstances, the air is thick with anxiety and passionate debate. A team member takes the lead, illustrating the stark contrast between projected growth and the harsh reality of loss. Amidst the strategizing, employees dive into discussions filled with urgency, noting every critical point as they ponder how best to communicate their findings and recommendations to address the losses effectively. With a sense of purpose, the business leader asserts the need for immediate action, inspiring the team to embrace change and tackle the financial reporting challenges head-on. Unity forms as they commit to transparency and accountability. Classification refers to the division of data into classes or categories, which enables the more effective provision of information from financial reports. This classification process occurs in both records and reports, aiming to produce outcomes that enhance control and planning. The special journals are exclusive in the data they contain, such as a cash receipts journal that solely includes cash receipts. Within the journal, different sources of data may also be classified, allowing for better organization and insight into financial activities. By classifying cash receipts according to their origins, businesses can gain deeper insights into their revenue streams and make informed decisions. This structured approach to classification not only aids in reporting but also plays a crucial role in effective planning and control. Ultimately, the reasons for classification circle back to enhancing planning capabilities and maintaining effective control over financial resources. With a clear system of classification in place, organizations can better navigate their financial landscape and position themselves for success. This meticulous approach not only fosters accountability but also empowers teams to make sound decisions based on accurate information. On April 28, 2011, in a quiet office, financial records were being meticulously updated, reflecting the careful management of a growing business. With each entry recorded, the individual strategized on how to balance their funds, hoping to turn the numbers into a profitable future. The task was not merely routine, it represented a crucial step in ensuring financial stability for the business, each receipt telling its own story. As the individual meticulously organized the receipts, a sudden mistake was discovered that would require immediate attention and correction. The revelation of the error weighed heavily on their mind, a reminder that precision was paramount in the world of finances. With renewed focus, the individual diligently revised the entries, turning the frustration into a learning opportunity and a chance for improvement. Once the corrections were made, a wave of satisfaction washed over them, knowing that they had restored accuracy to their financial landscape. As the day progressed, the gentle afternoon light poured into the room, symbolizing hope and new beginnings in their financial journey.